Hello and welcome back. Thank you for joining us for the week 2. We made it through week 1. Most of us made it through week 1. I know it was a lot of work, especially after just joining the course. I know that there was a lot of work that you had to do in week 1. I do appreciate your hard efforts in doing your best to make sure that all of your work for week 1 is complete. I know that some of you are still wrapping up a couple things from week 1. I do appreciate that and totally understand that. And I encourage you to make sure that you complete all of your week 1 work. So just to recap what was due during week 1, under the Engage and Explore folder, you had to complete the Excel Essential Training. You click on that, you'll watch several short videos. At the end of those short videos, at the very end of that, after you've watched everything, you'll earn a certificate. You'll download that certificate in a PDF format and upload it to this file here called LinkedIn Learning Course Excel Essentials. And of course, it has the due date associated with it. You also had the Chapter 2 discussion board, and then you had the Chapter 1 quiz and the Chapter 2 quiz. So again, to recap, every single week we have 2 chapters to get through, which means that there's usually going to be 4 things that you need to complete in each week. So that was week 1, which was due this past Sunday. Now we're in week 2, and today is Tuesday. So if we take a look at what's going on this week, we have, again, 4 things. The first is called an annotation video, and it's on adjusting entries, which we're going to talk about in Chapter 3. The second thing is another mini course called Financial Accounting Part 1. So here's the way it works. The annotations, what you'll do is you'll jump, first I recommend that you take a look at this, which is basically a how-to, how do you annotate something. So you'll watch this very short video, and then you'll jump into the annotations. The way it works is you will jump into this adjusting entries video. You'll watch this short video and you'll make annotations. The annotations are based off of these script. Okay, so here's an example of this. So I'm going to come in here and I'm going to highlight a part that I'm interested in. Okay, and then you'll click on this one that says annotate after you've highlighted the text. And the annotation is something like this. What would be a more efficient use of an accountant's time? So that, and then you'll click post. And so that is called an annotation. It's a note, and you're highlighting an area of interest on the text, and you're creating a note. So for this assignment, what I want you to do is create at least 1 annotation, ideally 2, then respond to at least one of your classmates' annotations. This is different than a discussion board, right? I'm trying to be creative here because I know that y'all don't love discussion boards. And so this is a more interactive way of working together in a class and learning from each other through these annotations. So we ask, it doesn't have to be long. Each annotation, we're talking maybe a sentence, right? Or maybe you're asking a question. And then I want you to respond to at least one of your classmates' annotations, or you could even respond to mine, right? So, and the way you would respond is this little arrow. It says reply. You just click on reply, and then you can type in your reply to my annotation. Yeah, is that clear? Does it sound reasonable and easy to do?
Yes, within.
Awesome, thank you. Any questions on how to do that, or it all makes sense? Great.
Makes sense. I've done the annotations in my last class, so
Oh, cool. That's great. Yeah, yeah. It's a relatively newer technology, so um, it's something to have fun with, right, in the classroom, and it's a interesting way to learn from each other. That's why I wanted to try it out in this course. This is the first time I'm doing it myself, so I just feel like it's a good opportunity to learn from each other. And the second thing you'll need to do for this week is another mini LinkedIn Learning course. So very similar to the way you did it last week. This week you'll select this one that says Financial Accounting Part 1. It'll open up another LinkedIn Learning set of videos, right? Here's the difference with this one is that some of these might involve some questions. This one doesn't, so that's cool. There's no some might have like little questions at the end of each chapter, but this particular one does not. So what you'll do here is you'll watch all of these videos in order, just let it run and listen and take notes and whatever. Once it finishes, you'll get down to this next steps one, and once that ends, it'll give you the opportunity to download your certificate just like before, and you'll download it as a PDF, and then you'll come back to the classroom and you'll upload it here. Okay, the same way you did the Excel training one in week 1. Then I'll provide you with a grade. Yeah. I always give the full credit, right? Even if you submitted a little late, I'll still give you full credit. Okay, I'm not going to penalize you. The point that I'm trying to get across by doing this type of exercise is that it provides you with that additional hands-on learning experience. And of course, it provides you with a LinkedIn Learning certificate, which you can post on your account. So I really think that these add value to both your resume and also to your learning experience, because it's something I think you'll remember, and that's why I want you to go through these things. So the hypothesis, you'll do 2 annotations and respond to your classmates. In the LinkedIn Learning, you'll watch all of the videos under Financial Accounting Part 1, download your certificate at the end, and upload it to this Dropbox here. Clear? Makes sense? Are we good with what we have to do this week? And of course, the two quizzes. All right, cool. Thank you so much. Appreciate it. Okay, let's go ahead and jump into it. Let's talk about adjusting entries. This is chapter 3 for those of you following along, and how to find the PowerPoint presentations. Come into the classroom under instructional materials. Go and click on this first one, instructional materials, and the PowerPoint's going to be right here. Yeah. So you can download that and mark it up, whatever works best for you. So it's there. Okay, let's go ahead and jump into our discussion on financial statement, adjusting entries, adjustments for financial statements. We call them adjusting entries. You hear me refer to that a lot. Okay, accounting. Sometimes we make errors. Sometimes we have to adjust for transactions that have occurred. We call these adjusting entries. The idea behind them is that we are adjusting our accruals, and I'm going to talk about what accrual accounting is and how it works. I just want you to think that for something like, we'll say, prepaid insurance, we prepay insurance, meaning we're going to pay up for a full year or two up front. That's what makes it prepaid. And as you remember from last week, a prepaid account like prepaid insurance, it's an asset account. It's an asset because the business can take that money back. Right? I can be like, you know what, I'm going to switch insurance companies, give me a refund. Right? You're entitled to that because that's your money. You paid it up front, but you can always take it back. You know what I mean? That's what makes it prepaid. That's why it's an asset, because you have a claim to that means that you already paid out. Now, what happens is at the end of each month, as we're using that insurance, we have to make an adjusting entry to help us to account for the consumption or the use of that insurance expense. And we do that through a concept called adjusting entries. And that's adjusting entries for a deferred expense. I'll talk about these things. So first, let me talk about the accounting periods and how we utilize accrual-based accounting. Accounting periods is based off of an amount of time that has passed. It could be identified as a month, a quarter, half a year, also known as semi-annual, or a year. These are the 4 different kinds of accounting periods: a month, a quarter, half a year, or a year. You see? The reason why we have accounting periods is because of the matching principle. The matching principle tells us that we need to match our revenues and expenses during the accounting period in which they occurred. Okay? And so that's why we have these accounting periods. Oftentimes, we use months, years. Those are the most commonly used accounting periods, months and years. Every month, we make the journal entries. We record the transactions as they happen. So we do that every month. At the end of that month, we go through the closing process, and then at the end of the year, you can see a complete record of everything that happened during that year. So that's the idea behind the accounting periods. Accounting, there's 2 methods that we use. Really, we use one or the other. And it depends on the kind of business that you're in. There's accrual-based accounting and cash-based accounting. Accrual-based accounting is utilized when products and services are delivered. We record the expense when they happen or when they are incurred. Okay? Accrual-based accounting utilizes accounts like accounts receivable, accounts payable. Those are what we call accrual accounts. Okay? Accounts receivable and accounts payable. The reason why accounts receivable and accounts payable are accrual-based accounts is because we're receiving or paying based on when the products were received or delivered. We received the bill, we haven't yet paid it. If we received a bill, that means we already recognized the expense. That expense happened. For example, we received the Pepco electric bill. When I received the bill, I look at the bill, and it was for the consumption of electric from the previous month, right? So you've used this much electric during the month. This is what you owe us. That's what the bill says. and you have to pay within 10, 15 days, whatever it is. It's accrual-based accounting. I record the consumption of the electric for how much it was in the month that it happened. And then later on, I'll pay that bill. The same is with revenue. With revenue, I make the sales, I collect the cash from the customer either over the counter at the time that the customer receives the product, or I ship the products to the customer and they'll pay me later. Either way, that's called accrual-based accounting. We recognize the revenue when we've delivered the good or the service. We recognize the expense when the expenses are incurred, according to the matching principle. That is accrual-based accounting. Not all businesses use accrual-based accounting. A good amount of them do. Most businesses that are either in retail or manufacturing, they all use accrual-based accounting. Retail and manufacturing, they use accrual-based accounting, mostly. Some businesses don't. The ones that don't, they use what's called cash-based accounting. Businesses that would use cash-based accounting would include businesses like a restaurant or another type of service business. They use cash-based accounting. And cash-based accounting is when we record the revenue when cash is received from our customer, not necessarily when the sale was made. We also recognize expenses when we pay them, not necessarily when they were incurred. Okay. Here's an example. Here's what I mean by this. Cash-based accounting, when the customer pays me, let's say they're paying their account receivable or they're paying me over the counter, I recognize the sale when I receive the cash, not necessarily when I made the sale. Example of this. Let's say I sold a product to a customer in the month of August, and today is September 1st. The customer pays me on September 1st. I recognize that sale in September because it's based off when I received the cash. That's cash-based accounting. For the Pepco bill, say I received the Pepco bill in September for the electric I used in August. I record that bill in September because that's when I'm paying it. That's cash-based accounting. Here's what the differences are, right? Reporting is different. If I use cash-based, the month of September is going to be higher than what it should actually be, because I made the sale in August. I consumed the electric in August. But if I'm paying in September and receiving cash in September, it's going to make September look great and August look low. See? So the difference is in the way that we do the reporting. So that's why it's important to understand the differences between accrual-based accounting and cash-based accounting. Any questions on this concept so far? We're doing okay.
We're fine.
Awesome. Cool. Thank you. Okay. Insurance example. Let's look at accrual-based accounting versus cash. Insurance. I prepaid my insurance for 24 months for a total cost of $2,400. So if I prepay the insurance for $2,400, let's say it covers 2 years, right? So it covers 2022 and 2023. I paid it in December. It also covers December 2021. On December 1, 2021, I paid $2,400 to the insurance company to cover 2 years worth of insurance. Here's what it looks like on accrual-based accounting. Accrual-based accounting, I spread the amount over the time period that insurance covers. I spread the amount over the time period that insurance covers. It's 2 years. It started on December 1. The policy started on December 1 and ended November 2023. Okay. So if the amount is $2,400 and it covers 2 years, that's 24 months, that equates to $100 a year. I'm sorry, $100 a month. At the end of each month, I record what's called an adjusting entry to represent the consumption or use of that insurance. I would debit insurance expense, $100. I would credit prepaid insurance, $100. What that does is it takes the $100 out of prepaid insurance, it puts it into insurance expense. That's because I consumed that month of insurance. You see, I'm recognizing the expense that the insurance covered. And I do that for at the end of every single month for that 2-year period. That is accrual-based accounting. What if my business used cash-based accounting? If my business used cash-based accounting, the way it would work is December 1, when I paid the 2 years up front, that whole month of December consumes the entire $2,400. This is cash-based. Cash-based accounting says I recognize the expense when the cash is paid. It doesn't matter if it's a 2-year policy. I paid it in December 2021. So December 2021 is going to look very heavy in expense for insurance. But the rest of the 2 years, the next 2 years, will have zero for insurance expense. You see? So that's the difference between accrual-based accounting and cash-based accounting. Now you might ask, Dr. B, which one is best? Which one should I use for my company? And my response would be, that depends on what type of business that you're in. If you're in retail, manufacturing, or a business where there's bills involved, or you receive the bill, you pay it later, or you have customers that pay you after you've provided the good or the service, then you want to use accrual-based accounting. Otherwise, you might want to use cash-based accounting if it's a small business and you only really bill in cash. Okay. So that would be my recommendation for that type of situation. But I will also say that accrual-based accounting is more accurate when it comes to financial reporting. And accrual-based accounting is recognized by the IRS, Internal Revenue Service, and it's U.S. Generally Accepted Accounting Principles, GAAP, compliant. Cash-based accounting is not. Okay, so I strongly encourage you to use accrual-based accounting. Yes, it's a little bit more difficult. It's more difficult to understand, but it is more accurate. So what about revenue? We recognize revenue at the time that we've delivered the good or the service to the customer. It's based at the amount that we expect to receive from our customer. That is the revenue recognition principle we talked about last week. It's also known as the matching principle, right? What about expenses? We recognize expenses the time the expenses were incurred. This is also part of the matching principle. It tells us that we match our expenses with the revenue when the transaction happened. So for example, my Pepco bill for August. I received my bill in September. I look at the bill and it says for the month of August, and it has the August dates on it. So I'm going to record that bill as an adjusting entry for the month of August. I'm going to date it August 31. Because I used that electric in August. So according to the matching principle, I have to record the transaction when it actually happened. That's how recognizing expenses works in accrual-based accounting. So how do we, Dr. B, you talked about these adjusting entries. How do they work? I mean, what kind of entries are we talking about here? Okay. There are 4 types of adjustments that we need to make based off of transactions and events that extend over more than one accounting period. Here's what I mean by that. For example, employee wages. Let's say the first of the month lands on a Friday, which in this case it does. September 1 lands on Friday. My employee works 2 weeks. I accrue their wages for 2 weeks, and I pay them the following week for those 2 weeks of earnings, right? The employee works for the 2 weeks, so what's it, 80 hours? I pay them for the 80 hours that they work, a week after the fact, right? So that means I'll pay my employee on September 8th. But here's the thing. According to the matching principle, I can't go into September 1. September belongs to September. So I need to make an adjusting entry for that one day for September 1. So I make an adjusting entry because it goes over into the next accounting period, right? So I make an adjusting entry, and that is for what we call accrued expenses. There are 4 types: deferral of expense, deferral of revenue, accrued expense, and accrued revenue. Here's the difference between deferral and accrual. Deferral means we haven't paid it yet. If we deferred, delayed, deferred. Accrual means we accrued, added up the expense or the revenue. Yep. That's the difference between the two. We make adjusting entries based off a 3-step process. Determine what the account balance equals to, determine what the balance should equal to, record the adjusting entry. Adjusting entry is made at the end of the accounting period, end of the month, to reflect a transaction or event that has not yet been recorded. Each adjusting entry affects one or more income statement account and one or more balance sheet account, but never cash. We don't adjust cash. We never adjust cash. because cash is physical, right? If we adjusted cash, that means we did something wrong. Okay. So the type of balance sheet accounts that normally get adjusted would be some of the payables, accounts payable, wages payable, taxes payable. Or it might be some of the receivables, accounts receivable. Might be prepaid accounts, prepaid insurance. Those are the type of balance sheet accounts that get adjusted, typically. The income statement accounts are usually expenses. So don't worry, we'll go through a couple of examples, but I just want to help you prepare to understand the basics. So let's walk through a deferral of expenses adjusting entry. Deferral of expenses. Okay, here we have a prepaid expense. Prepaid insurance, prepaid rent, prepaid supplies, I guess. We refer to these as prepaid or deferred expenses. Expenses paid in advance of receiving their benefit or consuming of that benefit. So here's the adjusting entry that we make. We debit the expense account, for example, insurance expense, and we credit the asset account, for example, prepaid insurance. What this does is it recognizes the consumption of that benefit. So in our earlier example, we prepaid $2,400 that covers December 1, 2021, all the way through November 30, 2023, 2 years worth of insurance. So December 1, I paid the insurance company $2,400. And so at the end of December, I need to make an adjusting entry to represent the use or consumption of prepaid insurance. So $2,400 divided by 2 years, which is 24 months, is $100 a month for 24 months. 24,000 divided by 24 months is $100. So at the end of December, I record a journal entry, adjusting journal entry. I debit insurance expense to increase the insurance expense, and I credit prepaid insurance to reduce my prepaid insurance account. And so here we can see the balance of prepaid insurance going down by $100. And we did that every single month until November 30th of 2023, when this balance reaches zero. Go ahead.
So, Professor, what you're saying is every month the prepaid insurance will go down $100, and you'll keep getting added the $100 to your expense.
That's correct. Yep.
Okay.
100% correct. And so what that does, Leland, is it shows that the expense is being recognized when when we incur it. That's according to the matching principle. Yep, that's correct. Well done. Yeah, so we would make the same exact journal entry at the end of every single month until this balance reaches zero, which in this case is 23 more months. And this shows you what that journal entry looks like. So we debit we debit insurance expense, $100. We credit prepaid insurance, $100. And this is the effect. Excellent. Very well done. Let's look at another type of adjusting entry, and this one's for supplies. Supplies adjusting entry, this is going to be another deferred expense, right? So here we have an example. Our company purchased $9,720 worth of supplies in the month of December. We used some of these supplies in December. Okay. At the end of December, we did a physical count, physical inventory. And our total unused supplies was $8,670. That means we used $1,050 of supplies in the month of December. So I need to make an adjusting entry to reflect the use of the supplies for the month of December. So I make an adjusting entry. I debit supplies expense, $1,050. And I credit supplies, $1,050. We can see what happens to the balance of my supplies on the balance sheet. It's reduced by $1,050 to show the consumption or use of the supplies. See, that's how adjusting entries work. We use them to show consumption of the benefit. And according to the matching principle of when that benefit was consumed. The reason why it's important to note the date, December 31st, is the end of the year. It's the end of the accounting period. I can't go into January with supplies expense because it's a different accounting period. Right? That's why we do the adjusting entry. So debit supplies expense $1,050, credit supplies $1,050 to record the use or consumption of that supplies. Here's the next thing I'm going to show you is a little bit more complex, but I'm going to show you in a very easy to understand method. And it is called depreciation. Depreciation is the process of allocating the cost of fixed assets like property, plant, and equipment over its useful life. Okay. Here's what I mean by this. Buildings, equipment, and other fixed assets like vehicles, machinery, equipment, buildings, all of these things lose usefulness over time. What I mean by that is they break down. Okay? Building's going to deteriorate if we don't maintain it. Absolutely. Machinery breaks down over time. Vehicles break down over time. Equipment breaks down over time. It's normal. That's life. Okay? Anything with wheels and motors is going to break down. Okay? They're not meant to last forever. They have what we call a useful life. They're most useful. They're helping the business to generate revenue. That's what a fixed asset does. Help the business to generate revenue. A building, a piece of machinery, equipment, a vehicle. These are all fixed assets that help the business to generate revenue. They go down in value. They go down in useful life over time. Because they wear out, you know? So we need to account for the cost of those fixed assets over their expected useful lives. This is called depreciation. If you have let's say you have a car. Some of you probably have a car. Your car, let's say you bought it brand new. The reason why they say not to buy a brand new car is because during that first year, it goes down in value. Because you drive it off the lot. It goes down in value. Why? Because you're using the asset. Okay? And as the asset gets used, it loses its usefulness. It's just how it works, right? It's said to be depreciating in value. That's where the term comes from. So, the way we calculate depreciation is based off of the formula that we use. The most commonly used formula for depreciation is called straight line depreciation. And it works like this. We take the cost of the asset, this is usually the purchase price of the asset, total cost to you when you bought the asset. The purchase price maybe plus installation, plus delivery expense, whatever. It's the total cost of the asset. Minus its salvage value. Salvage value is what the asset would be worth at the end of its useful life. Okay, so let's say you bought a $25,000 car. The cost of the asset is $25,000. Its salvage value is whatever it might be worth at the end of its useful life. We'll say $8,000. Okay? $25,000 minus the $8,000 divided by its useful life. Let's say the useful life according to the IRS is that your car will last 5 years. So the 28,000 minus the 8,000 divided by 5 years. That gives you the straight line depreciation amount per year. So at the end of each year, we make an adjusting entry for that amount. Depreciation expense, we credit accumulated depreciation. I'm going to show you what this looks like through an example. I want you to have a basic understanding of what depreciation is. So here we have an example. Our company purchased a piece of equipment for $26,000. The IRS tells us through what we call a maker's report. It's basically like a listing of what the useful life of things are. Useful life is 5 years for this piece of machinery that we have purchased for $26,000. At the end of its useful life, the salvage value, scrap value is sometimes what it's called, is $8,000. We purchased the piece of machinery on December 1 and started using it. So we need to figure out the depreciation for each year. So we take 26,000 minus the 8,000. Where's my calculator? I ain't that great at math. That's surprising. That's why I have a calculator. So 26,000 minus 8,000 gets us to 18,000, right? We get to 18,000 divided by 5 years.
3,600.
Thank you. 3,600. Well done. So 3,600 is the depreciation expense at the end of each year. But we see this. It says we purchased the equipment on December 1. It's a different accounting period. December 1 to December 31 is 1 month. So we have to spread it even further. So 5 years is also known as 60 months. So if I take the 18,000 and I divide by 60 months, I get $300. Thank you, Leland. Absolutely. So what that means is at the end of December 31, I make an adjusting entry. I debit depreciation expense the equipment, $300. I credit an account called accumulated depreciation for $300. What that does is it helps us to recognize the depreciation expense for the month of December because December is at the end of the year. That's why I have to break it up across months. Otherwise, I could do the $3,600 at the end of each year thereafter. Make sense? Leland, I saw your hand up.
I was just so does that mean for every month he has to do $300, or does he? Or, so it's not. So does it depend on? You said yearly you can do 3,600, but do they typically do something like that monthly or yearly?
Yeah, so typically it's yearly, but in this example, we bought the piece of.
Since you bought it. Okay, so that way that's technically a new period. You have to break it down even further.
Correct. You got it. So because we bought it December 1st instead of January 1st, because we bought it in the beginning of December, we have to break it out by month just so we can find the amount for December. Now,
so that way you don't mess up. Okay.
You got it. Exactly. But for the remaining 4 years and 11 months, I can do it on an annual basis.
Okay.
Yeah. Michelle. Michelle? Oh, I see your hand up. You have a question? For some reason, I can't hear you. No? The technology thing, I'm telling you. Happens to us every time, doesn't it? There she's thinking. Try to fix the microphone. Michelle, if you think of it, oh, okay, yep, speaker went out. Yeah, it happens. Michelle, if you think of it, you could always type it in the chat, or you could always try to log out and log back in, whatever works for you. I'll be happy to answer your question. So, in thinking about depreciation, understanding what had happened, right? We bought it for $26,000. It has a salvage value of $8,000. That leaves us a total net cost of $18,000. We divide that by the useful life, 5 years. Okay, we divide that by the 5 years, which is 3,600. In this case, we divide by 60 months, and that means that we spread it across each month $300. So at the end of December, we make the adjusting entry. Debit depreciation expense, $300. Credit accumulated depreciation, $300. Michelle, that's a loaded question right there. Give me 1 second, and I'll answer that question. That is a tough one. I'll explain it to you, but it's not something we're going to cover in this course. But I'll explain that concept to you. So depreciation expense $300, credit accumulated depreciation $300. it's important to understand what accumulated depreciation is. Accumulated depreciation is an account that is called a contra account. This is the only account that you'll ever see on a balance sheet. It is an asset with a negative amount. Okay, it's an asset with a negative amount. What that means is it contradicts, right? That's what the name contra account. It contradicts the equipment balance. Okay, it's a way of accounting for the depreciation without directly impacting the equipment account. The reason why we do it this way is because you cannot just simply deduct depreciation from the asset balance. It doesn't work that way. That's why we have accumulated depreciation. It's a contra account to the equipment. Michelle's question. Michelle asked in the chat, how does this work with things that appreciate in value, meaning goes up in value? Excellent question. So, here's how it works. Let's say, for example, Michelle, let's say we purchased this piece of machinery, $26,000, has a useful life of 5 years, okay? We get to the second year, we decide, you know what, we want this thing to last longer than 5 years. And we want it to be better. So we put a new transmission into the machinery. That is what we call an extraordinary repair. It makes it better than what it was. It's extraordinary. And so what that does is it increases the value of that asset. And the way that we account for that is we would actually increase the equipment cost. Okay, the equipment purchase price, we actually increase it by that improved value. See? So, Michelle, to answer your question, we would add that appreciation in value to the total cost of the asset. So that's how, and then of course we would need to make an adjustment of our life expectancy as well, right? Michelle, does that help to answer your question? But that's how it would work, is we would add into the total cost of that asset. For example, I think, Michelle, if I'm not mistaken, we were talking about real estate earlier, right? So with real estate, like a house or a building where the land goes up in value, that's how it would work. Is we would increase the total value or cost of that land or of that building.
Is this something that will be done yearly as well?
It depends. In a normal environment, we wouldn't do it until we're thinking about selling that asset.
Okay, yeah, that makes sense.
Yeah.
So you would track the depreciating value because it goes down in value, but for something that will go up, that's not something you'll check until maybe you were thinking about selling.
Exactly. Yeah, it's not something you do on a regular basis. For accounting purposes, we look at things that, because even with a house, we'll say, well, people think that, and this is a very common misconception, people think that because the sale price goes up, that means the value went up. Not really. Okay? What went up is the value of the land, not the building. Okay? Buildings go down in value. The houses go down in value, especially if you don't take care of it. Okay? It's not the value of the building, it's the value of the land. that the building is on. Okay? That's what's going up in value, not the building itself. So when you go to buy a house, you're like, oh man, Dr. B, I was going to buy this house and the price went up, like crazy. It's like, yes, everything did, right? But with houses, the reason why the housing market is the way it is today, it's not because the building got better. Land value went up, not the building value. That's the difference. Okay? So it's all about, what do they say? Location, location, location. They say values in the land. So that's why you see the housing market the way it is. Leland, go ahead.
That like, for example, like the houses in maybe or the neighborhood, some of the houses the price went up, but if you get someone to check your house, it might not be the same value as their houses because it wasn't as kept as nice or stuff like that. There's stuff you got to work on to
Yeah,
increase the value of the
there's
house.
a lot of factors that go into it.
Okay.
But the baseline is it's all about the land that the building is on. Yeah. Sorry, we went off on a little tangent there. I just wanted to talk about that because it's an interesting concept that most people don't quite grasp. Okay, so this is the journal entry that we make, the adjusting entry that we make at the end of December. Debit, depreciation expense, credit, accumulated depreciation. You'll notice we say for equipment because remember, accumulated depreciation is a contra account and it has to match the asset account that we're contra flowing. Accumulated depreciation holds a negative balance on the balance sheet because it's credited. It's an asset account, but we credit that one. Yeah, it's the contra the asset. Yeah, that's why I would do it that way. Okay, and we see over time what happens. So here we are, end of February. So that was December, January, February. 3 months went by. That's $900 worth of accumulated depreciation. So the equipment, the book value of the equipment is down to $25,100. Okay, so that's deferred expenses. Let's look at deferred revenue. Deferred revenue is unearned revenue. We talked about this briefly. Remember, I had my lawn business. I had my 2 customers, right? And so I said, hey, if you pay me now at the beginning of the month, I'll mow your lawn twice a month. Okay? So you pay me on the first of the month, and then later that month I come through twice and I mow the lawn. When you paid me that money up front, that's called unearned revenue. I didn't earn it. I didn't earn it until I mowed the lawn. Unearned revenue is when you pay or when you receive cash from your customer before you provided the good or the service. It's unearned. It becomes earned when we provide the good or the service. So here we have an example. We have a customer that paid us a 60-day fee in advance, covering what appears to be about 2 months worth of time. Consulting services. So the day we receive the cash from the customer, we debit cash $3,000 and we credit unearned revenue. Okay. Unearned revenue, that is liability account. It's unearned. Okay. It's a liability account. The reason why it's a liability account, because the customer can be like, yeah, I changed my mind. Give me my money back. See, that's why it's a liability. So Debit cash, $3,000. Credit unearned revenue, $3,000. Now we start working with the customer, so time is going by. We provided a couple days worth of service to this customer. Now, as the time goes by, we need to recognize that we are earning that revenue. So here we have we earned 5 days of service out of 60 days. It's $250 of earned revenue. So we can adjusting enter it at the end of that month. So at the end of February, we debit unearned revenue. We credit revenue, $250. But that's the adjusting entry that we make. So we debit unearned revenue and we credit revenue. So what that does is it reduces the unearned revenue balance. It increases our revenue balance on our income statement. And so this is the adjusting entry that we make. So that is an example of unearned revenue. What about accrued expenses? Remember, with accruals, it means that we're adding them up, right? So accrued expenses are costs incurred, added up during that period. They're both unpaid and unrecorded. Example is salaries. My employee works overtime. I accrue wage expense. It's unpaid and unrecorded. I don't record it until that 2 weeks has gone by. So here's the example. I have an employee who earns $70 a day. Okay. Which is $350 for 5 days. Our company pays every 2 weeks on Friday. Right? The end of the year just so happened to fall on a Wednesday. Okay, so that means I need to accrue wages for 3 days, Monday, Tuesday, and Wednesday. So I take $70 times 3, gives me an accrued salary of $210. I need to enter in the month of December. So I make an adjusting entry. I debit salaries expense, $210. And I credit an account called salaries payable, $210. Salaries payable is an account, an accrual account. It's a liability account that adds up the accrued wages for my employees. And after that 2 weeks goes by, add all the days that they work, I pay them. So debit salaries expense, credit salaries payable. The accrued wages. Those 3 days. So we see on our balance sheet liability, $210 for salaries payable. Salaries expense went up by $210 for the month of December. Time goes by. Okay. We recorded the 210 in December, and then the first week of January goes by. 7 days in January, Thursday, Friday, and then 5 days thereafter. It's $490 worth of salary so far for January. I debit salaries expense $490. I add December 2 days or 3 days plus 7 days in January. That's to get to the 2 weeks, right? 2 weeks, 10 days. So salaries payable, 210 to reduce my payable. Debit salaries expense, 490. And I credit cash to pay my employee. What about accrued revenue? Accrued revenue is revenue earned in the period that are both unrecorded and we haven't yet received the cash. Okay, so I'm going to show you what this looks like. On December 12th, we have a customer who agreed to pay us $2,700 on the January 10th of the next year for future services over the next 30 days. Sounds like a contract to me, right? On December 31st, we recorded 20 days worth of service that we provided to that customer, which is earned. So, how do we figure out how much that is? We take the $2,700 contract amount times 20 out of the 30 days. So 20 over 30 times 2,700. That means we earned a total of $1,800 for the month of December. So we make an adjusting entry. We debit accounts receivable, $1,800. Why accounts receivable? Because the customer hasn't paid us yet. And we credit revenue, $1,800, to record the 20 days of earned revenue. Let's look on the balance sheet. Accounts receivable went up by $1,800. On the income statement, revenue went up by $1,800 for the month of December. Now, here we go into January 10th. January 10th, the customer pays us the contract amount, $2,700. So I debit cash, $2,700. I credit the account receivable of December, 20 days, $1,800 to reduce the customer's account receivable. And I credit the remaining balance in revenue, $900. This records the receipt of the cash for the payment. This slide kind of easily sums up. I like this slide a lot. I apologize that it looks a little blurry. It looks blurry to me too. But this summary helps us to understand the difference between deferrals and accruals. It also shows us the adjustments that we need to make based off of the deferral or the accrual. It shows us the impact of financial statements. It's a nice summary slide. I recommend that you refer to this particular slide when you're making adjusting journal entries. It just helps you a real quick glance what you need to do. Yeah, that's why I like it. It's like a little cheat sheet, it just shows you real quick at a glance. So, what we do in accounting is we follow this. We've been following this accounting cycle for the past 2 weeks. Yeah, we started the accounting cycle this past Thursday. We're well into it now. One of the last things we do is the adjusting entries. After we've done our adjusting entries, we prepare what's called an adjusted trial balance. The adjusted trial balance is a list of the accounts and the balances of those accounts before the adjustments were recorded. It's found in the unadjusted trial balance. Then we made the adjusting entries, as you see in the two middle columns. We take the unadjusted trial balance amount for each account, and we add, subtract, depending on the adjusting part, find the adjusted trial balance. Adjusted trial balance is a list of the accounts and their balances after the adjustments have been made. You see, this helps us prepare the income statement and balance sheet. Because you can see at the top here, accounts 101 through 403, those are all balance sheet accounts. 406 through 690, those are all income statement accounts. How do I know? We always start with assets, then liabilities, and then equity. And we have our revenue and our expenses. Yeah. So once we prepared the trial balance, now we can create our income statement, balance sheet, statement of cash flows, and statement of retained earnings. We do that based off of the adjusted trial balance amounts. So, step one is prepare the income statement using the adjusted trial balance amounts. Once we've done that, prepare the statement of owner's equity using the balances from the income statement and the trial balance amounts. Step three is prepare the balance sheet based off of the statement of owner's equity and the adjusted trial balance amounts. That's how it's all connected. So that's the adjusted trial balance and how it's connected to the income statement, statement of owner's equity, and the balance sheet. Now I want to show you a couple of ratios. Ratios, as we talked about before, help us, managers, investors, and other people to make decisions in a relatively quick manner. Okay, that's why ratios are so important. And I, of course, once I made the decision, I can adjust. One of those ratios is called the profit margin ratio. The profit margin ratio tells me the relationship between sales and profit, or net income. It's important to know because it tells you the amount of profit you generate from each sales dollar. Obviously, that's a real important thing to know. So here's the way it works. We take net income at the end of the income statement, divided by sales, also known as revenue, at the top of the income statement. So net income divided by sales. This tells us the profit margin ratio. Look at the example here. We have Visa. Net income, $12,080. Sales were $22,977. That gives them a profit margin of 53%. That's huge. Okay, 53% is a lot of profit. That's a lot of profit for any business, let alone a credit card company, right? 53%. Again, helps us to understand the profitability of the company. These next few slides are part of the appendix, so we'll go through them a little bit quicker to just kind of help us to recap what we learned. Okay. The differences between cash-based accounting and accrual-based accounting. Cash-based accounting, we recognize the revenue and expenses when cash is paid or received. Accrual-based accounting, go through the process of making adjusting entries. We have an example using prepaid insurance. Cash-based accounting, we would just do prepaid insurance, debit, credit, cash. That's it. Insurance expense, credit, cash. That's it. That's the cash-based accounting. Accrual-based accounting, debit, insurance expense, and credit, prepaid insurance. That's the method. So it shows you the difference, between cash-based accounting and accrual-based accounting. Here we have revenue. Difference between cash and accrual-based accounting. At the top here, cash-based accounting. We debit cash and credit unearned revenue, and then we debit cash. All you're doing is you're debiting cash and crediting revenue. Cash-based accounting. When it's accrual-based accounting, we debit unearned revenue, then we credit revenue, and then when we earn it, debit revenue, credit unearned revenue. Again, it's just kind of showing you the difference between cash and accrual-based accounting. Any questions at all about adjusting entries, cash and accrual-based accounting? Anything? We're okay? We did all right?
I'm good. That's what recordings are for, so.
You're right about that, Leland. Absolutely. Very cool. Okay, so just to remind you about Chapter 3, coming back into the classroom, we have a couple of things. So in this week, number one, we have the hypothesis where you'll make annotations on this adjusting entries video. I want you to make 2 of them and respond to 2 of your classmates. And the way you do that is you open it up, you'll come in here, you'll make a highlight, like I did here. You'll highlight an area of interest from the transcript of the video, and you'll click annotate, and then you'll write in your annotation. Doesn't have to be long. It could be a question, it could be 1 sentence, a statement, or you're reinforcing that concept. That's a form of an annotation. Then you'll need to make 2 of those, yeah? So anywhere along here, and you could watch the video. It'll automatically go down the page. It'll automatically go down
Let's visit the accounting side.
As the video plays. It goes down. Yeah. So you'll highlight 2 areas, make 2 annotations, and then you'll respond to 2 of your classmates. And the way to do that is just click on this little reply button and type your response in. Again, 1 sentence, or ask them a question. Just make it fun. That's the idea here. So that'll give you, and then once that's done, I'll grade your hypothesis. And the other thing you have to do for this chapter is go through Financial Accounting Part 1 for LinkedIn, and you'll watch the series of these short videos. And at the end, it should take you probably about an hour and a half to get through, roughly. At the end, when it comes to next steps, watch that next steps. At the end of that, it will provide you with a PDF option for your certificate. You'll download that certificate PDF. You'll upload that certificate here, the Financial Accounting Part 1 certificate area. And you'll have the Chapter 3 quiz. Questions on what you need to do for Chapter 3? Clear, right? Good? All right. So we have a little bit more time left. So what I'd like to do, if it's okay with you, we'll get through chapter 4. So let's do chapter 4. Let me stop this part of the recording. We'll take a few minutes break. We'll start chapter 4. So stand by.